So in this lecture, I'll start a new chapter. Our next chapter is Prospectus and Allotment of Securities. Chapter 3, Prospectus and Allotment of Securities. So section 23 to section 42. This chapter is having two parts. How many parts? Part 1 is all about prospectus and part 2 is all about private placement. So in part 1 we will study section 23 to section 41. In part 2 we will study only section 42. Now how many companies we are having, ma? Actually how many types of companies we are having? Two types of companies we are having. Public company, private company. If public company need funds, they can go to existing members. First they will give preference to existing owners of company. So to the existing members, they can offer shares under rights issue, or they can issue shares at free of cost. We call them as bonus shares. Bonus shares. Or company can go to its employees under employee stock option plan. Or company can go to outsiders. Here outsiders, I classify them into two parts. One is identified persons. Company will identify few persons and company will give offer of securities only to those few persons. We call them as offer to identified persons. And the another branch, public at large. Public at large. So whenever a company is making an offer to public at large, it is the duty of company to prepare a document called prospectus. And if a company is going with identified persons, then it is the duty of company to prepare a document called private placement offer cum application letter. Private placement offer cum application letter. So private placement is regulated by section 42, whereas prospectus is regulated by sections 23 to 41. Is it clear? Now for private company, everything is same except one thing. What is that one thing? Except one thing, everything is same. Yes, private company can also offer its securities, ma. Private company can offer its securities to existing members for money. For money. If it is for money, existing members. If it is for money, it will come under rights issue. Rights issue. At free of cost, sir, then it comes under bonus shares. Bonus issue. Bonus issue, company will issue shares at free of cost. Company will not collect a single rupees when issuing bonus shares. Next one, a private company can also go to employees under employee stock option scheme. And a private company can also issue shares to identified persons. Identified persons using a document called private placement offer cum application letter. Understood? So only this element is missing. And the reason why this element is missing, you all know. Section 2 clause 68. What is the definition of section 2 clause 68 private company? Section 2 clause 68, the definition of private company. Private company is prohibited from inviting public to subscribe its securities. So that's why if you observe carefully, what are all the options available to public company regarding issue of securities? Same options available to private company except a public offer. And this is all about section 23. Clear? So what is section 23? Public offer, private placement. Public companies and private companies issue of securities. Simply I call it as mode of issue of securities. Public company can offer securities to existing members, employees as well as outsiders. Whereas private company can offer securities only to its existing members, employees. Next one, identified persons. Next one, companies are classified into two categories here. In one category you will find listed company, and next one, company in the process of listing. Company in the process of listing. And you will find in another category all other companies. All other companies means simply can I call them as unlisted companies, right? So private company is also an unlisted company only. Only public companies which offer securities to public at a large and which list its securities on recognized stock exchange, we call them as listed companies. Understood? Listed company is a company whose securities are listed on recognized stock exchanges. So now with respect to listed company as well as company in the process of listing, that means it filed an application for getting approval of listing. Once application is approved, we call it as listed company. Until that application is disposed of, we call it as company in the process of listing. Now in these two companies, I categorize activities into two parts. First I categorized companies into two parts. Now I am categorizing activities into two parts. So activities: issue of securities, transfer of securities, non-payment of declared dividend. Non-payment of declared dividend. And second category, all other activities. All other activities. Now if you observe carefully, listed companies and companies in the process of listing, in these two companies, three activities, namely issue of securities, transfer of securities, non-payment of declared dividend, will be taken care by SEBI. So who will take care of all these activities in these two companies? Come on, tell me. SEBI. Whereas all other activities of these two companies and all activities of all other companies are regulated by central government. This is all about section 24. So let me write section 24 in a clear manner. What is section 24, sir? Powers of central government and SEBI. Easy to remember, ma. Central government, how many letters? 2. SEBI, how many letters? Section 24. Understood? Powers of CG and SEBI. So once again I am writing here, just follow me. Company, how many types, ma? 2 types. One is listed company, and next one company in the process of listing. Company in the process of listing. Second category, all other companies. All other companies. Now in these two companies, I am categorizing activities into two parts. One is issue of securities, transfer of securities. Next one, come on, tell me. Non-payment of declared dividend. Non-payment of declared dividend. Who will take care of all these activities? That means who is having power to deal all these matters? SEBI. Remaining matters and all matters of all other companies. All matters of all other companies are regulated by central government. For example, we had one listed company, Reliance Industry Limited. If Reliance Industry Limited wants to shift its registered office from state of Maharashtra to state of Karnataka, whose approval is required? Central government approval is required. Now shifting of registered office from one state to another state falls in which category? Remaining matters category. And who is regulating this issue? Central government. Suppose if Reliance Industry Limited wants to issue securities to public at a large, now who will regulate that matter? SEBI. Getting my point? Everyone? Another example, suppose Reliance Jio Infocom Limited company is there. This is unlisted company. Now this unlisted company is planning to issue securities to its existing members. Now it is sufficient if they comply with the provisions of Companies Act. Yes or no? No need to comply SEBI regulations. Why? That company is not making public offer. Only companies which are making public offer for issue of securities, transfer of securities, and matters relating to non-payment of declared dividend are dealt by SEBI. Is it clear? So this is all about section 24. Now we completed two sections, section 23, section 24. What is section 23? Modes of issue of securities. Section 24, powers of CG and SEBI. Now just now I told you, if a company wants to make public offer, definitely it should prepare a document. Yes or no? It should prepare a document, and we call the document as prospectus. Simply, it's a document which contains company prospects, ma. It is a document which contains company prospects. It contains about past information of company, present information of company, and also future information. Future information means what, sir? Now, I am going to collect money from you. With that money, what I am going to do? What are my proposed objectives? How I am going to invest that money in the proposed objectives, how I am going to generate turnover, how I am going to get net profit. Everything I'll provide in prospectus. So this is completely future information. Again, past information. Yes, with respect to past information, I'll provide company achievements and company violation of provisions. As a result, how many penalties, company paid. I'll provide that information, achievements, punishments, everything I'll provide in prospectus. Present information, I'll provide current financial position of the company. That means balance sheet. I will provide current financial performance of the company, that means profit and loss account. So simply, it is a document which contains past, present and future information about the company. Yes or no? And what is the logic of issuing prospectus to public? I'll give you one simple example. Suppose you qualified, you cleared chartered accountant course. Now you are a chartered accountant and you want to join a job in tech companies, suppose Wipro, Infosys, TCS. Now to get job in that company, first what you will do? You'll prepare a resume and it contains information about yourself. Yes or no? It contains information about you. And you will send that resume to the companies. If companies are interested in you, they will select you. Yes or no? Now, resume is a document which tells about you. For simply, for getting a job, you are preparing a resume. Now, here company is going to collect crores of rupees from public. Yes or no? Yes or no? So, definitely, company should prepare a document which completely disclose information about the company. Okay, fine. Now, coming to the prospectus, we should satisfy certain requirements. And we are also having different types of prospectus. Coming to requirements, first, content of prospectus is very important. Contents of prospectus. And you can make any variation to these contents. Even after issue of prospectus. After issuing prospectus, if you want to change any terms and conditions, if you want to change objects of prospectus, yes, you can change it. We call it as variation. Next one, issued securities should be in demat form. So securities which you are offering to the public, must be in demat form. Next one, advertisement of prospectus. So simply, these are the requirements. Yes or no? These are the requirements before issuing prospectus. So what are those requirements? Can you tell me? Once again, what are the requirements, ma? Contents of the document, variation of prospectus objects, security should be in demat form, advertisement of prospectus. So you have to comply all these requirements. Then only you can issue prospectus to public at large. And we are having 5 types of prospectus. How many types? 5 types. One is deemed prospectus. Next one, offer for sale of securities. And next one, shelf prospectus, red herring prospectus and abridged prospectus. So shortcut you can remember like this, DOSRA. So dusra. Understood? So how many types of prospectus we are having? 5 types of prospectus we are having. Deemed prospectus, offer for sale of securities, shelf prospectus, red herring prospectus, abridged prospectus. And you have to remember this shortcut, DOSRA. Now first time, second time like that, in Hindi we can call it as dusra. Yes or no? Any mistake? No mistake, right? Okay. Now coming to section numbers, up to which section I completed? 24. Only 2 sections I completed. 23, modes of issue of securities. 24, CG and SEBI. Now deemed prospectus 25, contents 26, variation 27, offer for sale of securities 28, demat form 29, advertisement 30, shelf 31, red herring prospectus 32, abridged prospectus 33. So simply, for types of prospectus, it's 2528, 31, 32, 33. 2528, 31, 32, 33. 5 sections, 5 types of prospectus we are having. Okay, na? So before making public offer, it is the duty of company to prepare a document called prospectus. It should satisfy certain requirements, and we are having 5 types of prospectus. Coming to requirements, contents very important. Any variation allowed? Yes, variation is allowed. Variation. Next one, securities must be offered in demat form. And finally, advertisement of prospectus. So these are the requirements. And finally, types of prospectus, deemed, offer, shelf, red herring, abridged. Clear? Now, in this prospectus, yes, there is a chance of committing a fraud. First of all, tell me what is fraud? A promise made without an intention to perform, yes or no? Promise made without an intention to perform, we call it as fraud. Now we are specifying matters in the prospectus. Imagine some of the matters are false information, some of the matters contain false information, or some material information is concealed. Now we can call it as fraud, yes or no? So with respect to fraud, what will be the consequences? What will be the consequences? First one, first of all, if there is any wrong statements in prospectus, we call them as misstatements. We call them as misstatements. For misstatements in prospectus, we had two types of liabilities. One is criminal liability and second one is civil liability. Criminal liability, civil liability. Civil, how many letters? 5, so 35. And other than civil liability, it is criminal liability, section 34. Next one, next one is punishment. Punishment for fraud. Punishment for fraud. So this is for default persons, persons who are at default. Punishment for defaults. And last one is rights of aggrieved party. Rights of aggrieved person. See, in case of contract, you will find two parties. One party, who made fraud, we call him as party at default, defaulter. And the other party, we call him as aggrieved party. Yes or no? So for defaulted party, punishment, and for aggrieved party, rights. So punishment for defaulter, it is section 36. And rights of aggrieved person, it is section 37. Clear? So any wrong statements in prospectus, it leads to misstatements, it leads to punishment to defaulter, and it gives rights to aggrieved party. And finally, last one is securities. Last one is securities. Here we had total 4 sections. One is personation of securities. Next one, allotment of securities. And next one, securities to be dealt on stock exchanges. Securities to be dealt on stock exchanges. And last one, international securities. International securities, I call them as global depository receipts. So international means nothing but global depository receipts. So remaining section numbers, remaining section numbers, that means 38 personation, allotment 39, stock exchange 40, and GDRs 41. 42 already completed. Private placement 42, I told you. Small chapter compared to incorporation of company. This is small chapter. Weightage point of view, in one attempt 16 marks came from this chapter. On an average, you can expect 6 marks question from this chapter, but in one attempt 16 marks came. But minimum you can expect 6 marks from this chapter. Entire incorporation of company chapter is for 6 marks. And entire prospectus and allotment of securities chapter is also for 6 marks. Now you can compare the number of pages, you can compare the content. If you look into incorporation of company, it's approximately some 45 pages, whereas prospectus approximately 30 pages. Understood? So don't take this chapter choice, simple chapter. I can call it as category 1 chapter. Category 1 chapters, you should not skip these chapters. You should prepare 100% about this chapter, 100% of this chapter. So at the end of company law, I'll tell you, which chapters you should give first priority, which chapters you should give last priority. Understood? So now, come on, we'll revise section numbers. So we are having how many companies? 2 companies. And how many modes of issue of securities are there? 3 modes. 3 modes. What are those 3 modes? Existing members, employees, others. So 2 companies, 3 modes, simply section 23. 2 companies, how many modes? 3 modes. 2 companies, 3 modes. Even I can simplify section 23 like this also. Just look at section 23. 2 companies. What are those companies, Private, public. Company, private, public. So private company can go to its existing members, and private company can go to identified persons. Identified persons. Whereas public, it can go to existing members, it can go to identified persons, it can also go to outsiders. Public at a large. Public at a large. Only for the purpose of remembering section number, I am simplifying this section number. So how many companies we are having? 2 companies. And for public company, how many modes available for issuing the securities? 3 modes. Clear ma? So 2 companies, 3 modes. Section 23, modes of issue of securities. Private company can offer its securities to existing members or identified persons under private placement. Whereas public company can offer securities to its members, public company can offer securities to identified persons, public company can also offer its securities to outsiders, that is public at a large, through a document called prospectus. This is section 23. Next, what is section 24? 2 plus 4, 2 central government, 4 SEBI, powers of SEBI and central government. So come on, tell me, what are the powers of SEBI and central government ma? So here I classified companies into how many categories? 2 categories. Listed companies and companies in the process of listing. And second category is all other companies. Next, I classified matters into 2 types. In one part you will find issue of securities, transfer of securities, non-payment of declared dividend. Now these 2 companies and 3 matters are regulated by, 3 matters in these 2 companies are regulated by SEBI. Whereas all remaining matters of these 2 companies and all matters of remaining companies are regulated by central government, that is 24. Now, what are the requirements of prospectus and how many types of prospectus we are having? Coming to requirements, yes, prospectus should contain following contents. If you want, you can make any variation to the content of prospectus, and the offered security shall be in demat form. And prospectus, if you want, you can make advertisement. And coming to types of prospectus, deemed, offer for sale, shelf, red herring, abridged. So section numbers, for contents 26, variation 27, demat form 29, advertisement 30. Next, deemed prospectus, offer for sale, next shelf, red herring, abridged. For that numbering, 25, 28, 31, 32, 33. Any mistake in prospectus, we can consider it as a fraud. Now for defining fraud, that is nothing but misstatements in prospectus. For misstatements, we had 2 liabilities. One is criminal liability and the other one is civil liability, 34, 35. So what is the punishment to the defaulter? Section 36. What are the rights available to aggrieved party? 37. Understood? And finally, securities, personation of securities, 38. Allotment of securities, 39. Stock exchange, 40. International securities, global depository receipts. This you can remember like this, PAS. Our chapter name is prospectus and allotment of securities, yes or no? So personation, allotment, stock exchange. Just remember like this. So in this way you can remember 20 sections. Come on, tell me, what is section 23 ma? Section 23, modes of issue of securities. 24, powers of CG and SEBI. 25, deemed prospectus. 28, offer for sale of securities. 31, shelf. 32, 33, then 26, contents. 27, variation. 29, demat form. 30, advertisement. Fine. Next one, misstatements, criminal liability. 34, civil liability. 35, punishment to defaulter. 36, rights to aggrieved party. 37, personation of securities. First of all, I should ask section numbers, right? No, I am telling section. Actually, I should ask section number. Oh God. Okay, fine. Personation of securities, section number. Again, I am asking that only. So, okay, what is 38? Personation of securities. 39, allotment of securities. Stock exchanges, global depository receipts. Again I am asking like that only. Yes, fine. Now I'll ask numbers, you tell me the matter. So what is 23? Modes of issue of securities. 24, powers of CG and SEBI. 25, 26, contents. 27, 28, offer for sale of securities. Offer for sale of securities. See, 25, 26, 27, 28, and then 29, 30, 31, 32, 33. Okay, so what is 25? Deemed prospectus. 26, contents. 27, 28, 29, demat form. 30, advertisement. Then 31, 32, red herring prospectus. 33, abridged prospectus. Next one, what is 34? Criminal liability. 35, so 35, civil liability. Civil, 5 letters, section 35. Remember like that. Next one, 36, punishment to defaulter. 37, rights of aggrieved party. Next one, 38, personation of securities. 39, allotment of securities. 40, stock exchanges. 41, global depository receipts GDR. Next, 42, private placement. Section 42, private placement. Everyone, just open your material. One of the advantages of floating a company is raising of capital. See, for carrying business operations, how many options we are having? One is sole proprietorship. Next one, partnership. And last one, company. Everyone is having its own advantages and limitations. Suppose in sole proprietorship, who is the owner of the business organization? Sole proprietor. 100% profit sharing. Who will have? Sole proprietor. This is advantage. 100% control is with only one person. This is advantage. But 100% risk is also with a sole proprietor. Unlimited liability is with a sole proprietor. This is limitation. And another limitation, since he is only one person, he can contribute whatever he is having. Suppose to that business, total 100 crores money is required, ma. How much he can contribute? He can contribute only his net worth. Suppose his net worth is 80 crores. He can contribute only 80 crores. So there is a limitation on capital. Even if this sole proprietor, goes to banks for loans, if that person decided to go to bank, now he need to comply lot of conditions specified by banks. Only on fulfillment of conditions, bank will give finance. But there is a problem with the banker's finance. From day one onwards, he will charge interest. From day one onwards, he will charge interest. At the end of every month, I need to pay installment. Yes or no? Whether, I started business or not, whether I generated sale turnover or not, it is immaterial. From day one onwards, he will charge interest. And every month, I need to pay installment. So this is a limitation factor with respect to bank finance. Next, coming to partnership firm, maximum how many partners a partnership firm can have? Maximum number of partners in a partnership firm, 50. So here also you can find advantages and you can find limitations. Advantage compared to sole proprietorship, here 50 owners are there. So 50 owners can contribute something which is more than sole proprietor. But the disadvantage is joint and several liability. That means, one partner is not only liable for his share of deficiency, he is also liable for a share of other partners in case other partners become insolvent. Other partners deficiency, other partners share in deficiency. Getting my point, students? Now coming to company. So here, in private company, it can have up to how many members? 200. In case of public company, it can have unlimited number of members. So definitely compared to partnership, company can enjoy the benefit of raising capital. Yes or no? Since unlimited number of members we can have, so we can have members, unlimited members. That means we can raise finance, which is more compared to partnership firm as well as sole proprietorship. And raising finance, what are all the alternatives we are having? First we will go with existing members. Sir, what is the need of going with existing members? I'll tell you one simple example. Suppose in a company ABC Limited, one company is there. In this company total 10 members are there. Each member is holding 10% of paid up share capital. That means each and every person is having how much control? 10% control in that company. Yes or no? Now imagine company capital is 10 crores. Each member contributed 1 crore to company. So that's why that person is having how much control in company? 10%. Now ABC Limited, without intimating existing members, if it issues shares to outsiders, other people, Suppose these others are also 10 in number, and these 10 members contributed another 10 crores. So now total capital will be 20 crores. Now existing member, initially his control is 10%, but now his control will fall to 5%. That means his control in company is getting diluted. Yes or no? Yes or no? That means whose interest is getting affected? Existing members interest is getting affected. So before you go with public or before you go with outsiders, first you give priority to existing members. Why? The reason is it will not lead to dilution of control. It will not lead to dilution of control. Okay, 10% you may feel it is a small amount. For example, take Reliance Industry Limited. This company is having 6,000 crores paid up share capital. Out of 6,000 crores, 3,100 crores is held by Mukesh Dhirubhai Ambani and family members. And balance 2,900 crores are held by others. Now how much control Mr. Mukesh Dhirubhai Ambani is having in this company, ma? How much control he is having in the company? Just calculate 31 by 60, how much, ma? More than 50, okay, I need percentage. Just wait. So 31 divided by 60, it's 51.66 percentage, right? 51.66 percentage he is having. Now imagine, company need another 4,000 crores. Company without informing existing members, if company make a public offer and if company collects 4,000 crores from public, what happens now? Total capital of the company becomes 10,000 crores. In 10,000 crores, Mr. Mukesh Dhirubhai Ambani contribution is just 3,100 crores. That means he is holding how much? 31%. Previously, with his holding, he can control ordinary resolution. But now, he can't even control ordinary resolution. Yes or no? So, that's why first, whenever you want money, first you ask existing members, because existing members are owners of company. When you need funds, you will ask your parents, yes or no? So like that, when company need funds, first priority shall be given to existing members. First priority. That's why we call it as rights issue. It's the right of existing members to subscribe new shares whenever company offer its securities or shares. Getting my point? Why we call it as rights? It is the right of member to subscribe additional security whenever company issues additional securities. Suppose if existing members are not having funds, then what company will do? Company, after taking approval of members, what kind of approval? Special resolution. After taking approval from members, company will go with either identified persons or with the public at a large. Getting it? Everyone. Now, when company is raising finance, who will fix terms and conditions? Obviously company will fix terms and conditions. Suppose company is issuing preference shares. For example, preference shares, you all know what is preference share. Preference shares are shares which carry two preferential rights. One is payment of dividend and the other one is redemption of capital. When compared to equity shareholders, preference shareholders will get first priority with respect to payment of dividend, with respect to redemption of capital. Now how much dividend you are going to pay every year, and when you are going to redeem entire capital, who will fix these terms and conditions? Company. Suppose if the same body or corporate, that means if the same company is going to bank for finance, now who will fix terms and conditions regarding rate of interest, regarding tenure of loan? Who will fix? Banks. If we fix terms and conditions, we feel it flexible. Yes or no? If someone, if outsider is fixing terms and conditions, definitely it's a rigid. We can't be free. Yes or no? Now tell me, out of these three organizations, sole proprietorship, partnership, company, which is more flexible for raising finance easily, comfortably? Company. Yes or no? So if sole proprietor or partnership, if they go to bank, banks will impose n number of conditions. Like, bank will lend money only when you produce or when you provide 150% of security. Suppose you need 1 crore loan, right? You need to provide 1.45 crore worth asset as a security. When you provide 1.5 crore worth asset as a security, we will give you 1 crore loan. Whereas, companies making public offer, they are not required to follow these things. They simply ask public, if you are interested, you can come and subscribe our securities. You can deposit application money. Against application money, we will make allotment of securities. Every year, whenever company declares dividend, you will get share in profits. If company If company doesn't declare any dividend, that means you are not going to get any share in profits. So tell me, who is dictating terms and conditions with respect to raising finance? Company. Now, company can enjoy this benefit subject to certain rules and regulations. And all those rules and regulations I am going to discuss with you under chapter 3, prospectus and allotment of securities. So before I start, let me show you one simple small video. Just watch this 8 minutes video. Now I should watch entire. Sound will not come. Even sound comes, it's just machine sounds only. Who is making it? Actually, is it machines or human beings? Machines. So definitely we need a lot of investment on those machines. Everything is automated operations. So number of persons very less, whereas number of machines is very high. Yes or no? Now for purchase of machines, for installation of machines, and for conducting trial run, we need lot of investment and we also need lot of time. At least it will take 2 years, for setting up that factory. So far just body is completed, that's it. And again, engine, everything, it will be imported from other countries. Engine parts, tires, everything, tires from other companies. Engine will come from other country. So paint completed, or else I think this is a uh, paint or polish operations. All machines only, covered machines. So this is coloring. and this is engine part. So now tell me, after looking this video, so how much amount is required? Just imagine, almost approximately some 10,000 crores money at least we need, at least we need 10,000 crores money to set up that plant. Just imagine Hero company is there. It is a manufacturer of two-wheeler automobiles. Now Hero company wants to expand its operations. They want to set up four-wheeler automobiles. So at least some 14,000 crores money required. Present, company is having 4,000 crores and it need 10,000 crores. Now what a company can do? It can make a public offer. By complying with the chapter 3, prospectus and allotment of securities, it can make a public offer to public at a large. Interested investors from public, they will make investment. First they will deposit application money. Against application money, company will make allotment of securities. You will get shares. If company performance is good, your share value will increase. If company performance is not good, your share value will fall. Yes or no? So if you observe carefully, recently, if you make analysis, recently SBI cards, Paytm. So Paytm is the worst performer. So far, Paytm is worst performer. I think it collected around 2,100 rupees from investor at the time of allotment of securities. But right now Paytm is trading at 700 rupees or 600 rupees. Almost 60% investors lost their investment. Okay, fine. So I think now you understood the importance of raising finance. Clear? And moreover, one more point. After looking at that video, yes, it is very clear. For setting up that factory, at least we need minimum 1 year time. If I go with bank finance, definitely banker will charge interest from day one onwards. But from day one, I can't generate sales. I cannot generate sales. I cannot generate income. Then how can I meet interest obligations? So that's why, first I will observe whether my reputation is good or not. If my reputation is good in market, then I'll make public offer using a document called prospectus. Capital could be raised from public at large or from a defined group or inner circle, that is pre-known select group of persons. The former is called public offer. Public at a large, we call it as public offer. And whereas later one is called private placement. So if you go with identified persons, we call it as private placement. If you go with the public at a large, we call it as public offer. For public offer, prospectus is compulsory. Capital acquisition is inflow of funds for the issuer and needs advertisement which should be in accordance with the relevant legal provisions so that any investor is not defrauded or investor is not befooled. On successful closure of application process, securities are allotted to the investors who could be then listed on an appropriate segment of recognized stock exchanges. So we are having, seven stock exchanges, if I'm not wrong, but we know only two stock exchanges. One is, BSE and the other one is NSE. National Stock Exchange, Bombay Stock Exchange. In Bombay Stock Exchange, you will find 30 companies. 30 companies based on, these 30 companies were selected based on market capitalization. I told you Reliance is having a market capitalization value of 17 lakh crores, right? Number of shares into market value. So based on market cap, companies will be selected, and these 30 companies measurement can be found out in Sensex. Sensex is an index. Next one, Nifty. It is, NSE 50 companies. NSE 50 companies measurement index is Nifty. Since Sensex is having 30 companies, 30 large cap based companies, so Sensex will be around 80,000 points. Whereas Nifty, you will find 50 companies. Now weighted average of all these 50 companies, definitely it will be less than 80,000 points. So here it is 24,000 points. You can observe in market, right? Nifty, right now Nifty index is at 24,100 to 24,200. Whereas Sensex, it is approximately 80,000 points. How this index is getting measured, sir? It's simply weighted average of all these 30 companies in case of Sensex, weighted average of all these 50 companies in case of Nifty. Understood, everyone? In addition to these stock exchanges, we are having a commodity stock exchange, we are having a Kolkata stock exchange, multi commodities exchange is also there. Okay, fine. So our concept is not about stock exchanges, our concept is all about prospectus. The provisions relating to raising of capital such as issue of prospectus, allotment of shares, etc. and other matters incidental thereto are contained in Chapter 3 of Companies Act 2013, which is divided into two parts. Part 1, public offer. Part 2, private placement. So public offer section numbers 23 to 41, private placement section 42. Next one, section 23 already completed, just look at the material. Section 23, write about issue of securities by public companies and private companies. A public company may issue securities to public through prospectus by complying with the relevant provisions. A public company may issue securities through private placement by complying with the relevant provisions. A public company may issue securities through a rights issue or bonus issue in accordance with provisions of this act and SEBI regulations in case of listed company. Observe carefully, for listed companies only we are following SEBI regulations, whereas for other companies we just follow provisions of this act. This act means Companies Act. Come on, tell me, who is having power to frame company rules? Central government. That is all about section 24, powers of CG and SEBI. Next, so private company, how many modes? Only two modes. One is by way of rights issue or bonus issue in accordance with provisions of this act. Here you cannot find word SEBI. Here you cannot find word SEBI. Why? Private companies are prohibited from inviting public to subscribe its securities. That means private companies cannot make public offer. Since public offer is not there, no need to comply SEBI. Next, so through private placement by complying with the relevant provisions. And next one, prescribed companies, such class of public companies. Come on, tell me which companies? That means this subsection is not applicable to private companies. Section 23 subsection 3 is all applicable to public companies. Such class of public companies may issue such class of securities for the purpose of listing on permitted stock exchange in permissible foreign jurisdictions or such other jurisdictions as may be prescribed. Suppose I am having branch in Japan or I am having branch in USA or New York. Now these branches need funds. So here I am collecting rupees, again converting rupees into dollars, again sending that money to foreign branches. It is a time taking thing. Now what can I do, sir? Here I can directly offer securities in foreign countries and I can list them in foreign stock exchanges. Suppose for New York we are having New York Stock Exchange. For UK we are having London Stock Exchange. Getting my point, students? So now such class of public companies, either listed public companies or unlisted public companies, are permitted to list their securities on permissible foreign jurisdiction stock exchanges. Getting my point? So this section is giving power to public companies to list their securities on foreign stock exchanges. First of all, what is the purpose of listing? What benefit we get because of listing of securities on stock exchange? Can anyone? First of all, what is meant by listing? So what is the difference between listed public companies and unlisted companies? Can anyone tell me the difference? So very simple. Listed companies, stock exchanges permit them to trade their securities on stock exchanges. Stock exchange is like a market where n number of buyers, n number of sellers can come together and can exchange securities. And for trading securities on stock exchange, we need to get permission. We call it as listing. Now tell me, what kind of securities can be traded on stock exchange? Listed securities or unlisted securities? Listed securities. Whereas unlisted companies, if you want to purchase shares, you need to approach company management. If company management is interested in you, if company management think that you are a business person, you can invest funds into the company, then they will invite you to invest your funds. Understood? Tomorrow if you want to sell your shares, tomorrow if you want to sell your securities, you can't sell them over stock exchanges. You should sell them privately. Getting my point, students? Now today our stock markets, I told you, our stock markets are having almost 463 lakh crores funds. How much? 463 lakh crores. Out of this, at least 25% was contributed by public only. Why we are making investment? To get good returns. See, today we are having wide variety of investment options. Simple, risk-free investment, FDs. What is it? Fixed deposit receipts. On FD, we will get 6% interest, but it is very simple investment and risk-free investment. Since risk is less, your return is also less. And those who want more and more reward, they will go with more and more risk. Yes or no? Risk and rewards are directly proportionate to each other. More risk, more reward. Less risk, less reward. So if I am planning with a risk-free risk-free investment, I'll go with FDs. If I want more income, I'll go with shares. Suppose if the securities are listed on recognized stock exchange, I can make investment at any time and I can sell them at any time. That means I can mobilize funds at any time I need. Imagine if listing concept is not there, then only large investors, big investors like Mukesh Dhirubhai Ambani, LIC companies, only they will make investments, and rest of the Indians, rest of the public, they will not make investments. Only when funds come into the market, companies can use those funds, company can generate more and more number of goods, company can generate something to the economy. If you want growth in the economy, definitely investment should be a key. So more and more investments, we can generate more and more resources. Yes or no? If you had 10,000 crores, you can start that company. You can manufacturing a car. Just by manufacturing a car, government is getting a lot of money. For buying that car, first I should have white money. That means I should pay tax. That means I'm a direct taxpayer. And once you sell car to me, you need to collect GST from me and you will pay GST to government. GST is a revenue to government. And since I'm purchasing that car, you will observe funds will flow from customer to business entities. And in business entities, you will find labor, you will find investor, you will find landlord, and you will also find entrepreneur. All these four are nothing but factors of production. Yes or no? In economics, you studied flow of funds, from customer, households to business entities to households. So when money is getting generated like this, definitely that economy will grow. Are you getting my point? Only when economy grows, that country becomes powerful in the world. So definitely for growth, today stock exchanges are very much important. Just if you think that, if there is no stock market, private individuals, retail individuals like me, like you, will not make investment in stock markets. If they don't make investment, companies will not get funds. If company will not get funds, then company cannot produce more number of goods. If company is unable to produce more number of goods, then it can't pay desired salaries to its employees, it can't pay rents to the landlords, it can't give profits to the owners. Are you all getting my point? Now just tell me, keeping 1 lakh rupees in your pocket, is it good? Or making investment in a company, is it good? Investment, because of investment they can generate more number of goods. By selling more number of goods, they can generate profits. Government will get tax. And that company will pay salaries to employees, rents to landlords, profits to entrepreneurs. Since more number of goods are there, many customers will purchase those goods. Like that, money flow, there will be no stop. Money will flow like that only. Once, inflation or recession comes into picture, you all know what is inflation. Inflation means sudden increase in price of goods. Sudden increase in price of goods. Because of inflation or recession, one will not spend money on purchasing the things. If there is no demand, and if we had supply, there is no demand, if we had supply, automatically price falls. So during inflation period, what happens, some time period, maybe 1 month or 2 months or 3 months, in economy you will not find growth, you will find depression. Understood? Okay, we are completely going out of our subject, but everything is connected, everything is connected. Fine, just come back. So section 23 subsection 3 is talking about public companies. Public companies, if they want, they can list their securities on foreign stock exchanges. Next, section 23 subsection 4. This subsection is giving power to central government. Central government is having power to exempt any classes of public companies from complying with the provisions of chapter 3, chapter 4, section 89, section 90, section 127. Suppose IFSC public company is there. For IFSC public company, in order to provide more benefits, that means getting relaxation from existing provisions, central government is having power to exempt them from complying with these norms. So IFSC company, if you want to raise funds from public, no need to comply chapter 3, you can directly go and collect funds from public. Like that, central government can frame rules. So far not yet framed, just I'm telling you one example. Getting my point, students? Everyone able to follow? So section 23 subsection 4 is giving power to whom? Central government. And this power is regarding power to exempt any class of public companies from complying chapter 3, chapter 4, section 89, 90, 127. So with this section 23 completed. In section 23 we are having total 4 parts. Public company, private company, foreign jurisdiction, permitted foreign stock exchanges, and last one, powers of central government. Next, section 24. Regulation of issue and transfer of securities. 24 also I completed. Just look at the material. Securities and Exchange Board of India, we call it as SEBI. SEBI is empowered to administer those provisions under chapter 3 and chapter 4 of the act which pertains to issue and transfer of securities, non-payment of dividend by listed companies or those companies which intend to get their securities listed on any recognized stock exchange in India. I call it as company in the process of listing, ma? Yes or no? I can call it as company in the process of listing by making regulations in this behalf. So here you can find 2 companies. What are those 2 companies? Listed companies, companies in the process of listing. In these 2 companies, 3 matters. One is issue of securities, transfer of securities, non-payment of dividend, regulated by SEBI. And all other matters specifically provided in this act shall be administered by central government, tribunal, registrar. Yes, if a listed company wants to shift its registered office from one place to another place, it should comply the rules framed by central government. If a listed company wants to appoint an auditor, it is enough if they comply with the rules given by central government. Getting it? Everyone? Definition of public offer. Definition of public offer. Public offer, just read this word, ma. Public offer. So that means this is an inclusive definition. Definitions are of 2 types, ma. Inclusive, exhaustive. If you remember company definition, company means company incorporated under Companies Act or previous company law. Memorandum of association means memorandum. So exhaustive definitions define the word. It exactly defines the word. Exhaustive definitions, exhaustive definitions purpose, they define word exhaustively. They will give complete picture about the word. Whereas inclusive definitions, they will not define the word. In fact, they will give list of words covered by this word, list of items covered by this word. Suppose if you observe public offer definition, public offer includes IPO, FPO, next one OFS. That means here, this definition is not defining the word public offer. In fact, it is giving a list, public offer equal to IPO plus FPO plus OFS. IPO means upon incorporation. Upon incorporation, for the first time, company is making public offer. We call it as IPO. See, IPO can be done after 10 years of incorporation, after 50 years of incorporation, after 100 years of incorporation. There is no time limit for making IPO. But for the first time after incorporation, for the first time if it is making public offer, we call it as IPO. Any public offer subsequent to IPO, we call it as FPO. Understood? Second time company is making public offer, we call it as FPO. And offer for sale of securities. See, this offer for sale of securities, this is not fresh issue of securities. Company can issue its securities, or company can issue securities already subscribed by members. Securities already subscribed by members. I'll tell you one small example. I started one company, V Industries Limited, a big competitor to Reliance Industry Limited. Okay na? Proposal ma, but imagine. So V Industries Limited, which is a big competitor to Reliance Industry Limited. At the time of incorporation, no one knows about this company. Even I too don't know. I just incorporated company. So for carrying business operations, I made investment. Every year the company is getting profits. Again I'm making reinvestment of profits. After 10 years, the company valuation went up to 150 crores. Understood? Now I'm having another idea. I'm having another business idea. I want to float another company. For example, V Infocom Limited. Another company I want to float. And for this company, I need 50 crores capital. Right now, entire my investment is in this company. And my investment value how much? 150 crores. Currently, I am having zero net worth except this. Except this, other net worth zero. My cash balance, my bank balance and other fixed assets, everything is zero. My only asset is investment in this company and my investment is 150 crores. Everyone getting my point? Now to float this company, definitely I need funds. Now what I'll do, since this company is known to public right now, on behalf of this company, I will make an offer to public. Who will make offer? Company will make offer, but on behalf of whom? Existing member, simply promoter. On behalf of promoters, on behalf of members, company will make offer to public. Now, imagine I'm selling 50 crores worth of securities. So company is going to collect how much from public? 50 crores. With this money, do you think company will make investment in its business? No, 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 no. Company will return that money to selling shareholders. And this is known as offer for sale of securities. Are you all getting my point, students? Everyone? Suppose this company, for expanding its operations, this company require 100 crores money. Now company, what company will make? Company will make fresh issue of securities. In case of fresh issue of securities, whatever money company collects, company will invest in its business operations. Now tell me, how many types of issue we are having? Fresh issue and sale of securities belonging to existing member. We call it as offer for sale. Understood ma? So simply public offer, two types ma, IPO, FPO. In IPO, FPO, if company is offering existing shares which were subscribed by existing members, we call it as OFS, offer for sale. Here we are using the word called sale. And if it is fresh issue, so company is going to utilize the money. That's why here if anyone is making investment, we call it as purchase of securities. The person is purchasing securities. Coming to fresh issue, any person taking any share of the company in case of fresh issue, we call it as subscription. If you observe carefully to the MOA at the time of incorporation, what subscribers do? Subscribers subscribe MOA. So whenever company is making fresh issue of securities and investors making investment, we call them as subscribers and they are making subscription. Whereas company is offering its existing shares held by existing members, we call it as offer for sale. And persons making investment, they are just buying shares. One small doubt, can I ask you? In these two cases, where company paid up share capital will increase. In which case company paid up share capital will increase? Option A, option B? Option B, correct. Because of option A, there will be no change in capital of company. Because of option B, there will be increase in share capital of the company. Are you able to follow me? Everyone? So this is all about introduction only ma. All about introduction only. Can I proceed? Everyone? Another 15 minutes is there for break. So I'll proceed with next point. So now tell me, public offer. Public offer includes three offers: IPO, FPO, offer for sale. So offer for sale to public by existing shareholder through issue of prospectus. All our government companies, if you observe public sector undertakings, they follow this one only. For privatization, what they follow? They follow offer for sale. And who is the selling shareholder in case of government company? President of India. So if you take IRCTC as an example, in next class I will show you IRCTC prospectus. The selling shareholder is President of India. If President of India is selling 50% of capital of that company, imagine. Now that company is no more a public sector undertaking, privatization happened. It is like a private sector company. Understood? Next one, definition of securities. Now come on, tell me everyone, what is our chapter name? Prospectus and allotment of securities or shares? Securities. Do you think securities is a wide term or shares is a wide term? Obviously securities, because securities include shares. Shares represent ownership of the company. Shares represent ownership of the company. Any person subscribing to the shares of company, we call him as a shareholder. And you all know, basically shares are of how many types? Two types. Equity share capital, preference share capital. So shares, nothing but share capital of the company. It is a part of share capital of the company. Next one, scrips. This is a temporary certificate. This is also a share only, but this is a temporary certificate. Until original share certificate is issued, company will issue temporary certificate. So today allotment happened. Don't think that immediately company will issue share to you. They will give you a token. For example, they will give you a token. So and so date, company will issue shares to you. Until then, we call it as scrip. Getting my point, students? So it is also a security. Next one, stocks. Stock is nothing but collection of shares. Stock is nothing but collection of shares. And the difference between shares and stock, shares you can transfer only in numbers. Shares you can transfer only in numbers, like 1 share, 2 share, 3 share, 4 share, like that only. Whereas stock you can transfer in percentage. You can transfer 1% of stock. You can transfer 2% stock. You can transfer 5% stock. That means even in integers also. Integers only, right? Percentage means integers only, right? Natural numbers, whole numbers, prime numbers, odd numbers, even numbers. Concept is there, yes or no? Forgot, huh? No problem. I also forgot, but telling you, just numbers. Shares are available in numbers, whereas that stock is available in percentage. Now if you take a MRF company, the share value of MRF is around 1.4 lakh. Only with 1.4 lakh you can get only one share. Sir, I am having 70,000, sir. Can I get a half share? No. You need to purchase either one share or 2 shares or 3 shares. You won't get half share. But coming to stock, yes, you can take half stock. You can take 10% of the stock. That means transferability point of view, which is more flexible? Come on, tell me, which is more flexible? Stock. Stock is simply collection of shares. That's it. It's a bundle of shares. It is available in integers. It is available in fractions. In fact, it is available in fractions. Whereas shares are always available in numbers. Next, bonds. It's a debt to the company. Debentures, debt to the company. Debenture stock, similar to stock, debenture stock is also collection of debentures. Transferability point of view, debenture stock is more flexible compared to debentures. Next one, other marketable securities. Marketable means tradable. Any other security, whatever name you keep, if it is having marketability characteristic, we call it as security. So securities include, what is the first point? Shares, scrips, stock, debentures, debenture stock, bonds, and other marketable securities. Next one, come on, read the next point. Derivative. See, to understand this concept, just listen to the example. Suppose a farmer is there. He is having 10 acres of agriculture land, and that year he cultivated crop wheat, for example. Do you think is it a one-day activity? Definitely it will take months time. Now this farmer is worried about the price of wheat. Right now, imagine in market it is 8,000 rupees per quinta. For example, I am telling you. I don't know the actual prices. Example purpose I am telling you. Today for 100 kgs quantity, yes, what is the market price? 8,000. But this farmer is worried. It may take 3 months time to get this crop. After 3 months, if price falls to 7,000, definitely he will be at loss. So that's why what this farmer will do, he will enter into a derivative contract. He will enter into a future contract. In fact, we call it as future contract. It's not, present contract, future contract. The technical name of this contract is future contract. In stock market, we are having a concept called FNO, futures and options. In that I am talking about futures. So according to this contract, a farmer will enter into an agreement. Sir, for me, future price is immaterial, but I will sell this entire quantity at 7,800 only. And the other person, he will give acceptance. Now, after 3 months, whatever the price, even if price falls to 7,000, this farmer is having a right to sell at 7,800. And definitely this person has to purchase at 7,800. Getting my point? Suppose, after 3 months, if wheat price goes to 8,200, then what farmer will do? He will cancel this contract and he will go with 8,200 price. Why? In futures and options, the buyers of futures and options will get a right. They can exercise right or they can waive off their rights, no problem. Getting my point? Now, because of entering into this contract, definitely a security will be created, and that security is also a security. These contracts also comes under the definition of security. Definitely what these people will do, they will create one token. Okay, I will purchase all this wheat at 7,800 only. Like that, what he is giving? He is giving a token. We call it as derivative. Derivative is also a security. Another example. Now, I'll give you example regarding stock market. Right now, Infosys is trading at 1900 rupees ma. After 3 months, I'm thinking that share price maybe it may go up to 2,400. Why? Trump already won elections in USA. USA stock markets, they are full in bullish trend only. So definitely after 3 months, price will go up to 2,400. This is my analysis. But right now I'm having not that much capital. I'm having, less capital to make investment of, for example, 400 shares. For purchase of 400 shares, now how much I need? 400 into 1900. 400 into 1900, it is 7,60,000. Observe me carefully, follow me carefully. I want to purchase 400 shares. At which price? 1900. But right now I'm not having that much capital. How much capital I need to purchase 400 shares? Minimum 7,60,000 I should have. So right now I'm not having that funds, but after 1 month I will get those funds. After 1 month I will get those funds. But I'm having a fear. In this 1 month, if share price increases to 2,100, that means I'm going to lose how much? 200 into 400. I am going to lose 80,000 rupees profit. Or I need to invest 80,000 extra, which is over cost to me. So that's why what I will do, I will enter into a contract with one person who can sell securities to me. And I will enter into a contract like, I will buy 400 shares at 1900 rupees after 1 month. Now for entering into this contract, definitely, in a contract, a party who is at risk, definitely he will charge some remuneration. Yes or no? Yes or no? Definitely he expects some reward. So, to enter into this contract, I will pay some amount. We call it as premium. Suppose premium amount is 20 rupees ma. 20 rupees into 400, how much? 8,000 rupees. What I will do? I will pay it to other party who is giving me assurance that he will sell 400 Infosys shares at 1900 rupees. Just follow me carefully. This is completely out of syllabus, but just for your understanding, I'm telling you. Just for your knowledge sake, I'm telling you. So today I'm entering into a contract. This is option contract. So according to this contract, after 1 month, even though share price increases, it is immaterial to me. I will pay you how much? 7,60,000, and you should sell me how many shares? 400 shares. Imagine after 1 month, if share price reaches 2,000, definitely I'll be at profit. Yes or no? How much profit I'll be at? 400 shares into 100 rupees profit. That means how much? 40,000 is my profit. If share price falls to 1,800, imagine. And how much loss to me, How much loss to me, My loss is just 8,000 only. Sir, how come, sir? 400 shares, no, 400 into fall of price 100, 40,000, no, sir, your loss. No. After 1 month, if share price reaches 1,800, why I'll purchase shares from this fellow? I'll go to market and I'll purchase shares directly. Then what about this contract, sir? See, because of this contract, I am just getting right. I will not get any duty. I will get right. And it's my option. I can exercise right or I can waive off the right. So share price, if share price increases, definitely I will get profit. If share price falls, definitely I'll be at loss, but my loss is restricted to premium amount. Everyone getting my point? Now imagine, just imagine what is happening in stock market. I'll tell you. Now you know this person is having an option to purchase how many shares? 400 shares. Right now what is the premium amount? 20 rupees. Right now in market share price is 1900. And you know exercise price, at what price he agreed to purchase shares? 1900 only. Now you know day by day when share price started increasing, for example after 15 days, you know, after half month, share price went up to 1950. Definitely this premium component will also increase, yes or no? This premium definitely it will increase to some 60 rupees, at least 60 rupees. Why? Because another 15 days time limit is there. Our contract is for how many months? 1 month. 15 days over, within 15 days share price got increased to how much? 1950. Another 15 days it may increase. That's why premium amount will get increased to 60. Suppose by the end of 30th day, if share price reaches 2100, then premium amount from 20 it will increase to 200. First of all, everyone getting my point? You know, premium amount, it is nothing but token ma. The person who is selling that option, you know, he is giving me token. Using the token, I can purchase how many shares? 400 shares. At what price? 1900. So at the end of 1 month, I will have two options: either purchasing these shares, second option selling this token. I will sell this token to someone who is interested in Infosys shares. Imagine after 1 month, you know, share price is how much? 2100. After 1 month, you know, 2100 is share price, whereas exercise price is how much? 1900. Exercise price means, you know, at what price I'm ready to purchase shares. So agreed price is 1900. So 2100 minus 1900, how much? 200 rupees. Now if I sell this token for 190 rupees, definitely other person will purchase this token. Why? He is getting a discount of 10 rupees, right? So you know, if you observe this party, just observe carefully. If you observe this party is paying 190 rupees premium, and this party will pay 1900 rupees for want of share. So total how much he is spending? Just 2090 rupees. And what is the share value? 2100. First of all, everyone getting my point, students? Now that token is also called as security. The token is also called security. Generally in crude oil, in gold, in silver, we had futures concept. We call them as commodities. Commodity futures. Commodity futures comes under the definition of derivative, and derivative is the definition of security. Are you all getting my point, students? Everyone? I'll show you one small point. We had money control. Anyone can install money control app. But one point ma, don't do trading right now. Suppose if you take Reliance Industries share. In Reliance Industries, can you see this FNO? Here it is FNO. FNO is there. Can you see it ma? Where is it? Yeah, can you see this FNO? Yeah, fine. Now I will select one company. Which company you want? Adani Enterprises? No, Adani Enterprises, it is under ban. NTPC will take. NTPC. What is the current share value? 369 rupees 30 paisa. And you know, today is the expiry date for options ma. Today is expiry date of options. So if you observe carefully the FNO of NTPC. FNO. Here I can see. Just record this price. How much? 369.30. FNO. So here a stock. Which company? Which company I told you? Yeah, NTPC. Expiry date, here we will have 3 expiry dates. One is current month. Every month last Thursday is expiry date. This month expiry date is, you know, today only, Thursday, 28th. Next month 26 we are having. January we are having 30. Now if you take 28th expiry date, select options, so this is a future, right? I'm talking about options, yeah. So options, NTPC, expiry date today, option type, call option. I'll purchase call option when I think that share price will increase. And strike price, for example, strike price if it is 370, search option. So right now, that option is trading at what price, sir? Right now, calls, here you can see here. Call 370 call. What is the last trading price? 1.75. You can see it, right? 1.75. Suppose 375 strike price, exercise price. Suppose I will purchase at 375. If you observe carefully, last trading price is 0.45. And if you go up, what happens? The LTP is falling. The reason, today is the expiry date of this option. Today, suppose if the share price of this NTPC right now it is trading at 369, yes or no? Today if 10 rupees increase is there, definitely this 375 call option will increase to 5 rupees. Why? Share price 370, whereas the strike price is how much? 375. At the end of the day, actual price 380 minus strike price 375. What is the difference? 5 rupees. Just tell me, are you understanding these points, ma? Okay. Now, I'll take another month expiry. Instead of November, I'll take December. Now, December means almost we are having how many days? Some 25 days we are having time. So in 25 days, imagine share price is increasing every day 3 rupees, 3 rupees, 3 rupees. Definitely, we will get more profits. If share price is increasing, we will get more profits. So now if you observe carefully, I selected December month option type, call option, strike price 370, search options. At what price it is trading? It is getting traded 12 rupees. This month it is just, how much? Approximately 1 rupee 70 paisa is there. Whereas next month option it is 12 rupees. Why? Because it is having more time. In next 3-4 trading sessions, suppose if share value increases by 20 rupees, definitely it will increase by 100%. In next 3 to 4 trading sessions, if share value falls by 20 rupees, this option value will fall by some 8 rupees or 6 rupees. Actually, last day, that means, on Wednesday, share value got increased by 6 rupees. That's why this option got increased by how much? 2 rupee 90 paisa. Now, these options futures are known as derivatives. Derivatives are also called securities. Understood? Huh? Okay. And one more point, one last point. Units or any other instruments issued by any collective investment scheme to the investors in such schemes. Suppose every one of you is having 10 lakh rupees. No, 2 lakh rupees. Every one of you having how much amount? 2 lakhs. With the 2 lakhs, how many securities you can purchase? How many company securities you can purchase? If you take MRF, you can purchase only one security. That's it. Yes or no? So that means with the 2 lakhs, you can purchase only one company securities. You cannot diversify your investment. And we had a statement that, don't put eggs in one basket. Why? If that one basket fails, everything gets destroyed. And if you make investment in a single company, if that single company is not performing, definitely your investment value will fall. Yes or no? That's why we need to make investments in variety of companies. But for us, we had only less resources. We had only less money. With that limited money, we can't make investment in more securities, more company securities. That's why we had a concept called mutual funds. In mutual funds, what happens, small investors will deposit funds with mutual fund companies. Aditya Birla mutual funds is there, SBI mutual funds is there, HDFC mutual funds is there. Now investors, small investors will make investment into these mutual funds. And these mutual funds, after pooling these resources, they will make investment in a particular sector, or they will make investment in all sectors after calculating risk. Since, these people are well educated and they are well informed about stock markets, they will take more precautions before making investment in companies. Now tell me, individual making his own investment, is it safe? Or mutual fund companies making investment safe? Mutual fund companies making investment is safe because they are well aware of facts, they are well aware of stock markets, they know risk and reward strategy. So now these mutual funds, whatever units issued by these mutual funds, those units are also treated as securities. Getting my point? Everyone. So 10 people, for example, A, B, C, D, E, F, G, H, I, J. These 10 people, each person is contributing, imagine 1 crore with Aditya Birla mutual funds. So yes, 10 people contributed how much? 10 crores. Now with these 10 crores, Aditya Birla mutual funds, it made investment of 2 crores in Reliance Industry Limited, 2 crores in Bharati Airtel, 2 crores in IRCTC. Like that, it made investment in 5 companies. It made investment in 5 companies. Now these investments, against these investments, yes, Aditya Birla mutual funds will get shares. Shares are also considered as securities. Next one, against investments by the small investors, Aditya Birla mutual funds will issue units. Units. And these units are also called security. Everyone getting my point, students? Everyone. So with this, I conclude this session. We'll have break 45 minutes. After that, I'll continue remaining points.